Welcome to the WION podcast, where we explore fascinating stories and ideas from various fields. In this episode, we explore why a major new report from JP Morgan is challenging the idea that the global AI surge is overheated, as fresh financial signals hint at something deeper unfolding behind the market's rise, leaving many to question what truly powers the boom. Here, the financial groundwork behind the optimism finally reveals its shape. A new JP Morgan analysis concludes that the ongoing surge in AI-related investments is supported by strong financial fundamentals rather than speculative mania. The bank finds no evidence of an AI bubble forming at this stage. While sharp inflows and high expectations could create bubble-like conditions in the future, JP Morgan states that today's AI rally is being driven by genuine earnings power, deep capital expenditure, and accelerating adoption across industries. According to the report, forward price-to-earnings ratios for listed AI companies have actually fallen over the past 3 years, even as earnings per share estimates have more than doubled. This dynamic, lower valuations alongside higher profits, suggests the sector's financial strength and contradicts the classic warning signs of a speculative asset bubble. He notes that this valuation behavior is fundamentally different from past bubble eras, where prices rose dramatically without corresponding earnings support. Another key finding is that the aggregate cash flow from operations for major AI firms exceeds their capital expenditures and dividend payouts. In simple terms, these companies are paying for AI expansion through their own operational cash, not by borrowing money. This stands in sharp contrast to historical bubbles, such as the dot-com era, where companies relied heavily on cheap financing and speculative capital. He says that financial innovation in the AI ecosystem is accelerating, with new models emerging in areas like private equity, energy contracts, and venture capital. However, the bank finds no evidence of deteriorating underwriting standards or reckless financing, which often precede widespread asset bubbles. The report emphasizes that financial strength remains a central pillar behind today's AI growth cycle. Supporting infrastructure for AI, especially data centers, remains exceptionally tight. The report highlights that data center vacancy rates have fallen to an all-time low of 1.6%, and about 75% of capacity currently under construction is already pre-leased. This indicates robust demand, high utilization, and little risk of overcapacity. Key components across the computing, power, and data center supply chains remain scarce relative to demand, reinforcing that expansion is driven by real usage. Recent earnings reports from major technology companies confirm that AI is now materially contributing to revenue growth. This direct link between AI adoption and corporate performance further strengthens JP Morgan's conclusion. AI spending today is supported by measurable returns, unlike past periods when investment raced ahead of real demand. JP Morgan draws parallels with the UK railway mania of the 1840s and the dot-com bubble of the late 1990s. Both saw capacity built far ahead of demand, leading to crashes. However, in the AI cycle, capacity is lagging behind demand, not overshooting it. The report notes the absence of cheap speculative capital, weak balance sheets, or inflated financing structures, classic ingredients of bubbles. Today's AI surge, JP Morgan concludes, is powered by fundamental earnings expansion, not speculative assumptions about future revolutions. Thanks for tuning into this incredible story. If this episode resonated with you, don't forget to hit the like and subscribe button for more captivating stories to come. Stay tuned.